Investing Insights with Right Property Group, exploring trends in real estate and helping property investors gain financial security.
G'day, hey gang, Phil Tarrant. Welcome to Property Investing Insights with the crew over at the Right Property Group, Reshmi and Victor Kumar in the studio. Gang, back together.
Yeah.
Another month.
Another designing of decades.
Yes, the decades certainly flow by, don't they?
Yeah, they certainly do. Do we factor in seismic changes like we're seeing to property markets as part of our discussions around this special series on designing your decade?
Yeah, absolutely.
We've spoken about it, right? We told
Yes.
you so, yeah?
Yes,
Yeah.
we did. And if you go back, historically in the podcast and every piece that we've put out, we've always alluded to, expect changes. Nothing's for granted in property investing. Nothing's granted in life, right? So there's always going to be changes. You got to expect the changes, know how to deal with them, and know how to pivot when things do change, so that you can actually play within the new rules of the game, but the game remains the same.
So
We're seeing the changes now. So,
Yeah.
Absolutely.
how much has it changed?
Wow.
A bit, a lot?
On which aspect? There's a lot of changes everywhere.
Yeah.
So
Well, we don't need to talk about tax settings and stuff.
But I think that's been done to death, right?
Yeah.
But I'm talking about the actual dynamics of real estate markets seem to, I saw Tom Panos, who most people would know, sort of, all over the morning TVs and this, that, and the other, saying it's the worst market he's ever seen or the most challenging market he's ever seen.
Yeah, I tend to agree with that. I mean, like if you look at during the GFC, the reduction in median pricing was about 8%. But now we are freely talking about double digits at the moment.
the other thing is we can't forget there's been so many buyers agents who were not actively present at that time. There's the inflation, the increase in prices are driven by them as well. So now when it's correcting, there's the difference.
I think you did a piece on buyers agents, didn't you?
I did.
Yeah. About how they're distorting the market.
Well, I've got to be careful because I'm speaking to buyers agents, but I've been very vocal about this for a decade.
Yep.
In relation to all that is good about the buyers agent sector, but mapping its growth over the last sort of 5-6 years,
I think
accelerate coming out of
it's
COVID,
accelerated,
post-COVID. I've been very sort of vocal about it. You've been the fact that you are able to, you've got the efficacy to actually do a special series on Design Your Decade. You've seen a couple of them,
Yes.
as professionals and investors. So I think it's appropriate to be able to reflect on well over 20 years buying real estate in the market as a professional buyer's agent. I think that's appropriate, but there's still a lot of Johnny-come-latelys who only really come to the party buyer's agents post-COVID, right? I've written a piece on it.
What I privately call the ChatGPT powered buyer's agent.
Yeah, there's a lot of it, right? And there's been quite a lot of sort of headline scalps sort of has happened, and I would say still to come in relation to this whole industry in this sector. So, but the point is the professionals that you choose, you want them to actually have longevity and experience, and rather than reading about market cycles and looking at data and reflecting on it, to actually have lived it. I think there's something to that.
The lived experience is the best. Yeah.
Yeah, and if I can take it down on that vein, since we've opened that can of worms, right?
You opened it.
Yeah, did I?
Yeah.
Oh no, but you wrote about it.
Yeah, I wrote. People like my writing. I'm doing more journalism these days, and
It's a foreign thing for you, isn't it?
I still got it. I still know what I'm doing.
I know you did. It was a good piece. A good piece. Yeah. So if you look at what's happening in the market today and talking about buyers agents, I'd be very mindful of knee-jerk strategy and making up the numbers, not in terms of the properties, the cash flow, but numbers in terms of the sales for the business. So this is something that you need to really mindful of. Okay, where's their advice? Where's their bias? Where is it all coming from? Is it because they were a volume-driven business, so now they're trying to keep up the volume because the volume naturally was underpinned by a large number of staff, right? Or is it quality? And are they actively telling you not to buy, and also at the same time pushing you to do X, Y, and Z within your portfolio? Yeah, so need to be really careful for at least for the next 12 months where the advice is coming from.
Yeah, and we're sort of towards the back end of this cycle of everyone scrambling to secure residential real estate inside their SMSF. I think the deadline's 10th of August. It's really the 9th. You've got to be contracted. Another piece I wrote was don't let your buyer's agent's marketing campaign become a retirement strategy.
Yep.
Right. And to your point, it would feel strange for your buyer's agent property strategy, we're going to call it, to say don't do anything, because most of them you speak to them and they go, yeah, buy. It's always a good time to buy. You're telling people no.
No, I'm telling them no. Yeah. And it's only the ones that actually make sense within their portfolio to purchase something within the SMSF in that small window that we have. And then you need to think of the logistics of it, right? So yes, okay, cutoff is 10th of August or ideally 9th of August. But let's say you did exchange on the 9th of August. Then you did your pest and building report and it was not up to scratch. You're out nowhere. Right, so if you were to do something really this week and perhaps the 1st and 2nd of August, is it? So it just gives you that extra 5 days to do your due diligence. And if it doesn't, it isn't a good property, you've got still enough time to replace it.
Yeah.
And that's the point about still being able to replace it, because my biggest fear with the whole SMSF side of things, it's connected obviously with what I'll chat to you gang about today, is people who are settling on contracts for off the plan stuff in their self-managed super fund, because you just think about it. If you sign a contract on the 9th of August for an off the plan purchase, whether it's a house land package or some sort of unit in a development, and say the thing doesn't get out of the ground for 2 to 3 years, which potentially could be if they can't get the pre-sales on this stuff, you're tying up all that money in your super fund, the 10% deposit for that period of time, on a contingent sort of settlement that may happen, that you may not be able to get debt against because you don't know how the rules may change. Obviously, it's contracted before then, but is there actually going to be any lenders in the market for new properties on that at that point in time? But more importantly, is the price point going to stack up? And already it's I've been chatting about this already for a long time. Now everyone's out of the woodwork talking about valuations not stacking up in off-plan purchases. So there's some mistakes being made right now.
Absolutely.
I think people, without realizing what they're doing, is like, let me go and put myself in jail and lock myself out in this extremely important opportunistic market and let me sit here and not do anything while everybody else takes advantage by doing something like that. That's what happens, but they don't realize that that's what they're doing.
Well, if you have this long settlement because you've got a bill, right? And if I'm the lender, I know I've got you over the barrel, right? Because I can jack up my rates. And there's nothing you can do because you actually need to get the finance on it.
Yep. Yeah. Well, imagine, look at that. You do your assessments in this market, but you fast forward, the valuation doesn't stack up. You got to find another $100,000.
Yep.
And you thought you were borrowing at 6.7%, but really you're borrowing at 10%.
And throwing in more capital
into it. So there's got to be a lot of hurt.
There will be. And everyone, all of the listeners would know, we are not big fans of off-the-plan properties for this very reason, right? Because you can't predict the future. Generally, you're paying some marketing fee to someone when you buy a house and land or off-the-plan properties. So already you're paying more than what the property is worth.
Well, this is it, right? I can't remember the number, but it's like 40 to 50% of all costs connected with a new build property is government levies and developer costs and all this sort of stuff. Is not the inherent value of the property itself. So buyer beware.
It's not for an investor, really. If you really want to make a portfolio and then derive income from it, these are not strategies for investors. This is people who are uneducated about how properties work, and these are the strategies people go down thinking someone did this and I better do it too. This is not smart investor type stuff.
It's dangerous, and this is all sort of obviously investing in property in a slowing market, which I really want the topic of today's conversation to be centered around. But looking at SMSFs, we saw some data recently which said that the government's made its assessments thinking there was about 4,000 loans, limited recourse borrowing arrangements connected to SMSF investing annually, but there's other data coming out now saying it's 16,000. So that's 4 times as much. So potentially the government is undercooked its sort of thoughts or visibility towards SMSF borrowing arrangements and how that actually will fuel development moving forward, because 30 to 40% of all off the plan developments is to SMSF property investors. So
which makes sense, right? Hence the discrepancy in the numbers, because the off the plans don't necessarily get counted until they are ready to settle.
Yeah.
Right? So there is potentially a greater pipeline in the works as well from this borrowing scenario that hasn't been taken into account.
yeah, I'm going to put it out there. I reckon they're going to
Repeal it.
Yep.
I agree.
Yep. They're going to have to do it. I don't think. I'll go on record, but I don't think it'll last 12 months.
No.
So all these people scrambling now, back to the point, to capitalise on this for the immediacy of a deadline.
And paying a little bit more for the property that they
paying a little
should
bit
have.
more. Victor, you know it. Reshmi, you know it. I've seen some real clangers getting put in front of people I know are investing. I'm just saying, this is actually recommended to you by a buyer's agent. Like, do they have any idea what sort of asset should sit inside of a super fund that comes through sort of reasons?
See, they're a buyer's agent. This is where I want to clarify, people not understanding. A buyer's agent, just like you have a real estate, you have a listing agent, a selling agent, there is a buyer's agent, someone who will find you a property. So you just look at them as an agent who will find you the property. They don't necessarily have investment experience. So you can't relate like what we do. Our team, we have our team of buyers agents. We ourselves are buyers agents, but the added thing we also have is the investment experience. So when we talk to somebody as a buyer's agent, there's a difference. And so we are about building somebody's portfolio rather than finding them a property. We're finding them the right property that will build their portfolio for them so that they can derive an income or whatever they choose to do with it after a certain number of years. And this difference is what people need to be able to see. And we cannot be classed as a buyer's agent or other buyer's agents cannot be seen as us because there's so many out there who haven't got that experience. It's the investment knowledge and experience that you have to look at in order to decide who you work with. And that is one thing I always feel like needs to be for people to understand the difference. And that part just gets me all the time.
It just gets lost in that. And we acknowledge that people got to start from somewhere, right? So we started at one point where we didn't have necessarily.
But we had investment experience. We had investment experience, and that's why we started the buyer's agency business, because we wanted other people to not feel this way and provide them the support and build their portfolio so they're not wasting time and money. And that was why we started it in the first place. We didn't just start from let's start a business and
because you wanted a side hustle.
It wasn't a side hustle, right? So it was like we were all in, and in line with your article in that sense, right? So what we really want to see is there needs to be a level of strategy along with the recommendation of the property. So it's not just like, hey, you've got a budget of 800, I'll find you an 800 and I'll focus on the data of it to say, okay, this area is going to go up in value and here's your property. There needs to be a strategy around it for that property and then the greater strategy around the portfolio.
Absolutely.
So that you're then really going in a direction towards your goal rather than just being someone that's done a knee-jerk reaction and just purchased.
Yeah, and there's a lot of knee-jerk reactions when it comes to property investment. And what I'm seeing already, and maybe you can give some colour to this, is the narrative of property strategists is already changing away from rapid capital growth that you can extract equity and keep going and building to a yield type play and a cash flow type play, of which we've been chatting about over this special series of Design Your Decade. But what I want to introduce is a special series inside of our special series Design Your Decade, if you're okay with that. So a little 3-part sort of crystallized focus specifically connected to this market, so how to handle an actual slowing market.
Yes.
And most of the commentary you see coming around this right now is that the sky's falling in because property values are going south.
Yep.
And isn't that really, really bad? You want to balance that with some commentary or stats coming out of, no doubt supported by the government, that 60% of Australians are happy if their prices go down in value because it helps other people enter the market. I don't know. If I ask 100 people that I know, I can't think of 60 of them that would be happy with that. circumstance, right?
Yeah.
But this is the market that we're in right now. It's a slowing market. So what does it all mean? And I think we've got an opportunity over the next sort of 3 episodes to give some guidance in relation to this. And it's probably going to be covering off a lot of the stuff that we've spoken about over Design Your Decade. We're just sort of pulling out the books from the shelves now, which is relevant for this particular market. How do you guys feel about a slowing market?
I love it, right? And this is where you've got 2 options here, right? You can decide the sky is falling in and run for the chicken coop, or you can actually look up and see, okay, the sky is actually not falling. It's just a little bit overcast. Yeah. And so if I look at today's market, we've been through this.
And look at if my eggs are hatching.
Yeah, that's right. Yeah, the eggs are definitely hatching, right? So, yeah. So if we look at our journey, our personal journey, we've been through 2 or 3 of these markets, right? That might not have been as significantly telegraphed, because now we've got instant news with social media and headlines and whatnot, right? So all the clickbait-worthy headlines that you see. And most people, unfortunately, these days are, especially when they're starting out, are investing via headlines, not through fundamentals. So when we look at the closest comparable we have, it is the GFC. And then the next comparable we have is the 2017 APRA clampdown, right? So at that time, the market did compress. It became harder to buy. During the GFC, money was hard to get, which is hard to get now, right? Vendors were heavily motivated back then. Vendors aren't as heavily motivated right now, but they are starting to get motivated. And when you look at all of these things coming together, it's just a matter of dialing it back to the fundamentals. Take away all the giggle money from the market.
Giggle money.
Giggle money, yeah. Because we were in the giggle money's phase, right? So we were.
Is that something he's been thinking about, perhaps? Giggle money.
Giggle money. Yep. That's the term I coined.
Is that stupid money?
Stupid money. Stupid money. Yeah. Because you're paying overs for properties. Where you're trying to get onto the property because everyone's trying to get the same piece, right? So a little bit of FOMO coming in, a little bit of market pressure coming in, but the market pressure is from the wrong end, where they're trying to get onto the bandwagon, because we've had very recent social proof during COVID of phenomenal growth. Yeah. Right. So we're anticipating the same growth to continue. So that's the giggle money. Now that's gone out of the market. Yeah. So now we've
Trigger's gone forever.
No. I reckon, and I'll go on record for this, I reckon that come late January, this will become a normal market where the negative gearing would be a thing of the past, because you've got the New Year's resolution, you've got 6 months worth of, negative gearing is no longer there. And you'll start getting the normal momentum of property investing.
This is the new norm, and market would reset as well.
But do you think it's actually going to operate in a way in which the government intends that growth will be slower than what it has been previously?
Debatable. Ultimately, it'll come down to flow of money. There may be some innovative products that might come out from the banks. And if you look back during the GFC, there were several banks at that time. So we're talking 9% interest rates back then. There's several banks then with ATO approved products where they did a hybrid of, you pay, make repayments on the 450K split, and the other 450K will capitalize the interest, right? So it made properties affordable so people could buy. And that's what it ultimately comes down to, is everyone can buy, but can they hold on? Yeah. And that's the key.
Yeah. So how do you hold on then in this market? So this is all about how to handle a slowing market. So there's 2 parts of a slowing market. It's you're already a property investor. So what do you do about it to ensure you're maximising your portfolio? And the other side of it is I'm in acquisition phase, and we could probably deal with those 2 things separate. Obviously they're interconnected, but we can deal with them separately.
Well, The first bit is we talk about the established investors and people that are just starting out. Right?
Yeah.
So they've got the two approaches.
Yeah.
For someone that's just starting out, it could be that we are very selective in what we buy. So we're still buying within the means of, okay, this is going to be within our negative cash flow tolerance. And then we want to protect our deposits going in. Right. So we're anticipating the market will cool down a little bit more. The general consensus is, okay, I'll wait until the market totally cools down. We don't know. Right? By the time the lenders would be a bit more skittish, the valuations might not stack up as high as your purchase price, because there becomes a big disconnect between vendor expectation, bank risk management, and your affordability. Yeah. So we need to protect that more from a mindset point of view than anything else. So there's a couple of things you do. So for the first-time investors, maybe rethink the high loan-to-value ratio loans, because if it cools by 10% and you're on a 90% LVR loan, you've got no equity left.
No room to move. Yeah.
Yeah. And then perhaps go the 80%, maybe lean on the parents and do that parental guarantor loans so that you're going in 80-20. And then you're looking at the value adds and on the property that you bought. Value add is several ways, right?
This is talking about established investors now, going back to your portfolios. Yeah.
Yeah. So that approach becomes a two-pronged approach. First-time investors, you're looking at value add from the viewpoint of, okay, maybe you're buying specific properties where you can add value. So what we were doing back in the day when every property that we bought had a renovation twist.
Yeah, it did.
Yeah.
Every single property.
Used to buy for that purpose.
Yes.
Yes.
Yeah. So if things went wrong, we've already added value. We could offload. We're not losing money. We're just losing time. And that's the approach. So we need to bring back the renovations.
Yeah.
You know how they said bring back the biff. We're going to bring back the renovations. Yeah. So
And then soon the headlines will be renovation.
yeah.
So,
Yeah. Well, you mark my words. It will become a thing, right?
It will be. It will be. You just have to be, don't do renovation for the sake of renovating, and don't renovate to your liking. It all has to be within what works.
The playbook is there.
The playbook's already there.
1 quarter burlap base
Yes.
for the walls,
and the
anti-white.
with
USA, I think, for the ceiling.
Ceiling was with a dollop of black in it because then it masks all the stains.
It's all the playbooks there.
Yes.
Yeah.
So that was when you had what you talk about here is manufacturing equity,
Pretty much,
right?
pretty much.
So you're not going to. The market won't shift the value of the property, so you need to shift the value of the property in the market that you're operating in.
Yes.
Yeah.
That's right.
It's just the numbers are probably a bit different now. What
It
do
is very
you reckon it would cost now to do? Say, let's think back to that place we did in Cambridge Park.
Yes.
So
that was a 42K reno from memory.
$42,000. Yeah. 4 bed, two
bathrooms.
2 bathrooms.
Yep.
Yeah, an
And a
ensuite on the
carport.
master and a carport.
Yep.
Floors, paints, kitchen.
2 bathrooms.
2 bathrooms.
Yep.
Some stuff outside.
Fix the windowsills.
Fix the windowsills. We didn't paint it. No,
We didn't paint the outside. We painted the inside.
We redid the carport.
Yep.
You're $42,000.
Yep.
What's that in today's dollars? You're in for 100.
Oh, yeah, easy. Yeah,
Probably 100.
yeah. Probably 100 would do it. Yeah. Well, kitchen these days. So
you
back
have
then,
to do a lot of the work yourself.
Yeah, absolutely. Back then, your kitchen was, I think, from memory, was 5,000 something.
Yeah, but you can still get a kitchen. I did a kitchen recently through a Bunnings kitchen, one of those caboodle kitchens, manufactured and installed for sub 10.
Yeah.
For cabinetry.
Yeah.
Then obviously you've got sort of appliances in and around it as well. So you're probably in for 15 for a kitchen.
Easy. 15 easy.
You've been for a smallish bathroom, bath or
20.
shower, you're in for 20.
20.
Floors, you can just get your floors polished in a normal house for about 5.
Yeah. Well, we did yours for $1,600.
Yeah, I did some floors recently. It was about that. That's all. That's the cheap stuff. It's the
it's the labor.
It's the labor is where you get done. Your materials largely is still. You can get a house painted internally for 5 to 6 probably.
And you and because we've opened that that now kind of warms.
Talking
right?
very specifics, right?
Yeah. So if we bring it to today's market, right? So Reshmi and I just did a reno in Melbourne, right? So we bought a house very cheap for land value. It needed everything inside, right? So this is understanding trades. This is understanding how much things do cost. So my initial quote was $76,000 to new kitchen, refurb the bathroom. So it was a brand new bathroom, new plasterboards throughout. There are too many holes in there.
You sheeted the whole house.
Yep.
Yeah. Okay.
Rewired, replumbed the lot, right? So it was coming into 76. Cheap. Yeah. But
Is it getting one bloke to project manager for you?
It was, yeah. But then I latched on to another bloke who had done a few other renos for myself and my clients, and $42K.
$42K?
For the exact same thing, yeah. The difference was the 76 one was going to be in and out in 2 weeks.
Yeah.
This one took me 2.5 months.
Okay.
But I still came on top.
So did the guy do it himself, live in the place?
Yeah, pretty much. Yeah. He potted around, did his stuff. Quality was just the same.
Yeah. Okay.
Didn't take any short.
42.
Yeah. So full refurb, 42. That can happen.
And what again, we're talking specifics, but people like specifics. How much of the labour was he doing himself? So did he sheet it himself and plaster it himself?
Pretty much. He was practically there 24/7. Yeah. The only thing that he outsourced was the
electrical and plumbing, probably.
Yeah.
But so you can do a cheap refurb it on.
Yeah.
Wow.
Do the grunt, like we used to say back in the old days, do the grunt work yourself.
Yeah.
Yeah, we didn't do the grunt work
Sweat
ourselves.
equity.
Sweat equity.
So the thing is that you would have made a calculation that said, well, 2.5 months, I'm carrying the mortgage repayments for 2 more months and what I did versus 30 odd K in hard
practically
costs.
half.
Yeah. And did you have to capitalise the works because you purchased it, or did you sort of repairs and maintenance it? Because if you do a reno straight after buying, you've got to.
Well, there's no income coming in.
There's no income coming in.
Technically, you can't.
Yeah.
But that's something the accountant can handle.
Yeah.
Now, if you look at it from how has that impacted us in the 2.5 months? This is the other thing, and tying back to this in terms of speed of movement, right?
Yeah.
So had I used the other bloke, he would have been done and dusted within 2 weeks. This was pre-budget. So my valuation would be sitting at the 650 mark. Whereas after, because it took 2.5 months to do, my bank valuations come in at 540. Now, it's a very light on valuation.
Yeah.
So
is it desktop val or an actual?
No, this was an actual walk-in val.
Okay.
Sorry, I lie. The first one was a desktop. So we asked for a walk-in, and that came in, I think, 30K higher.
Okay.
Yeah.
So the market moved that much?
The market moved that much.
100 grand.
Yeah. So if you're slow in your action in today's market, and which is part of protecting your deposit, is that speed is what matters, the rapidity of making decisions, but also not just giving all the dough away.
Yeah. So in hindsight, did you make the right decision? Do you think you should have done it faster, got a high val, pulled the equity out? It's been 100 grand difference, right? Versus
it would have been, but we
would have had to come up with that money upfront to pay, and so we didn't, and we were in a position which didn't really matter in that way. So
so if you look at it from this is a keeper, right? So this my plan there is to then at some point in time put a secondary dwelling on it.
Okay.
So it doesn't matter if the bank's perceiving that it's going to be 100K cheap, less in value.
Yeah.
I know that the valuation I'll pick up in the next 24 months anyway when the market bounces back up.
And do you think, how did you change the sort of rentability of the property by doing this work? It would have essentially been a new place.
New place, yeah.
So rents are being quoted at the 420 mark for this. It's not a it's a lower socioeconomic area.
Yeah.
So if we hadn't renovated it, rent would be around the 320, 360 mark. So not a huge gain in rent, but from a percentage wise, it's a gain.
It's quite a lot more.
Yeah.
So this is like in these markets, how do you handle a slow market? You got to sweat the small stuff.
Yes.
A lot more.
Yep.
It's a lot less forgiving, and to your point, you've probably got greater flexibility in terms of whether or not did you make the right decision by going the cheaper option and losing some time. Well, you've got a large portfolio, so it balances out.
Correct.
Those type of decisions. They're not as significant, right? But if that was your first property. And you're looking for an equity uplift to recycle your deposit as quickly as possible, you probably would have wanted the high valuation.
But it was.
But you might have ended up in negative equity then.
True. Yeah. So it still would be able to recycle the deposits and the costs out in this exercise, right? I won't talk the specific numbers because then everyone will want that number. Yeah. Because each
I want one of them. Give me one of them.
Each area is different. Each property is different, right? So. If I were just starting out, yes, it would slow you down a bit, but you're not spending so much money in the front end. Understanding that any property we're looking at it from two facets, the two sides of the coin. One is the immediacy of it. So how can we get our money back out as immediately as possible, and how can we work it as efficiently as possible. But then we also, on the other side of the coin, looking at the medium to long term. So we need to understand, which comes back to the equity side of things and understanding how to protect the deposit is now where it was at when the giggle money was in, right? So the height of the market, what pricing it would get. And now what you're buying now in comparison to everything else, and making sure you're comparing apples with apples.
So how much of this then, how to sort of handle a slowing market, is making smart decisions now to wait to the reversal of the market back to where it was? So you've got essentially a floor at what it should go back to. It's just a matter of how long that takes, and every market is going to be very different. So do you have a view on how long we're going to be in a subdued market?
How long is a piece of string?
Where is the question? Like, whereabouts? It's,
I'm thinking give good 12 months. We'll see a bounce back.
Because we are still in an undersupplied market. We still got people that have got a lot of equity behind them. And investing is the new thing anyway, right? It has been for the last 10 years, the last decade. So it's a matter of, okay, we had hit a big wave. So the boat has stalled. It's just temporary stalling, and then it powers ahead again, right? So it
takes a while for people to get used to it. And
to
then,
the change.
Yes, and then go on again.
So a lot of this is a confidence.
Very much so.
It's not the market pulling back; it's confidence pulling back largely.
And you can already see the headlines dying down, right? So you're seeing less and less of this strident, negative gearings gone, headlines and all this sort of stuff. So now for the next probably 1-2 weeks, we'll see the SMSF headlines, and then the true markets will start emerging as to how much momentum we've lost, because temporarily the SMSF purchases are buoying the market up or stabilizing the market, more to the point. But then you've got other seasonal things happening, right? So people will start to sit in front of the accountants, and the accountants would start saying, okay, you need to perhaps look at property. Maybe it'll be more tilt towards newer property to pick up the tax deductions. Or the good accountants will say, okay, you need to start looking at wealth creation, which would then mean that there's more people coming in to purchase established properties. Then on the other side, people will be sitting in front of accountants, and the accountants say, do you realize this property is costing you 40K a year? You need to offload this because you haven't got enough cash flow to hold on to it. So there'll be a little bit of balancing seasonally there. And then the next big season would be your New Year's resolution, which will, in our opinion, reset the market.
Jolt the people a bit and then make them rethink and then, go again.
So you got to be a bit more, you've got to be braver or more courageous in this market in order to capitalise on it. But that's certainly a mindset thing. So if you've got experience, I'm sitting going, like you, what a great time. But a lot of people think you're mad by doing that.
We can't think like that and stop buying. We just have to know that this is what it is right now. And if I have the ability to purchase, I would purchase, and I would make sure that I'm all my risks are minimized as much as possible. And just as you said, not maximum borrowing, because we are still not, it hasn't come to a stop yet. And if it falls further, then you know that you've got room to move. So you've just got to protect yourself along the way, but you can't stop buying, because you won't know when the bottom is, like when you've hit the bottom of the market. So if you got opportunities and you have got the ability to buy, you should be buying. And
so it's an important point. So buying on the way down, it doesn't matter where the bottom is if you're buying on the way down, as long as you don't need to sell. So long as the area's got fundamentals. Right? So if you bring it back to the share market, right? We look at every advisor, every book, every seminar out there, they say buy heaps more when it's trending down, so long as the fundamentals are there. Which is the same with property. You don't have to buy heaps, but buy within your means. But definitely look at areas that have got extreme fundamentals. So the key fundamental is your owner-occupier content in the area, which has to be above 60%, right? So those areas don't necessarily take such a big hit unless it's an unusual property in that area or an outlier in that area. And we were talking offline about our recent purchase with our interim PPOR while we do our construction, where we took advantage of the market and we picked up a property that potentially was $1 million cheaper than an offer they had rejected in February. It's good buying. Yeah. So buying on the way down has other advantages, and that is there's a lot less competition.
Yes.
There, and therefore you get greater pick of the stock. Whereas when you start buying on the way up and
everyone's jumping in.
It means there's a lot more competition on places, and the pick of the stock's probably
and you invariably pay more. You're paying half of what you could have bought now. You're probably paying 5% more at that time. As the market comes back up again, so you're pretty much paying the same price today as you would in say 6 months' time, except you are not able to get as good a term position. So there's two sides to buying a property: is the price, and then there's the terms. So you might not get as good a term when you're buying property in 6 months' time. Right now, you could potentially dictate the terms.
And the terms could be really long settlement.
Correct.
And if it's a renovation and things
early
like
access
that.
to do the
early
renovations.
access. So you can sometimes, if you package it really well, you can actually still buy on the way up, but you've just controlled the purchase for the period of time while you've explored where the bottom is. That sort of grey that sits there for a period of time, and this is where you need sort of experienced guidance, support, professional support, largely to understand a lot of these dynamics. But you can, if you're creative with this stuff, you can get a lot of things cracked out. And when things are down and if people are desperate to sell, the terms become really negotiable. And you think about real estate agents. A real estate agent, if a place sells for 30, 40, 50, 80, $100,000, $1 million, it's all relevant, less than what they think it is. For the agent themselves, it's largely irrelevant what the price is. They just need to do the transactions. They might be making 1.5%, 2% on $100,000. Like, does it really matter to them whether or not they sell it today versus sell it tomorrow? They want the deal done. They'll sell it. They'll sell it today. So real estate agents will be really, really motivated to work with you during this period of time, which means flexibility.
It does. And if you look at the phone calls we are receiving now from the agents and the properties that are being pitched to us, 4 months ago they were not talking to us, right? And now all of a sudden they're starting to come out of the woodworks. Because that's the market, right? So it does.
That's the market. People need to sell for whatever reason. So back to the fundamentals then. So you've got to be confident to be buying on the way down.
Correct.
With a view towards you don't know where the bottom is.
But
it can be sort of assumed. You've got to protect your deposit. These are basic fundamentals. So 60% owner occupied.
That's a non-negotiable.
What else is non-negotiable?
So obviously you want more income flowing through that community. So it has a basic platform. It is not unlikely to drop below that from a pricing point of view. You definitely want to have more professionals in the area rather than social housing. And So you're looking at the fundamentals of liquidity, right? Rentability, sellability, lendability, all of those things. And then when you come to lending, obviously, you know that the big four, obviously with their negative gearing calculator gone, the lending is not as robust in terms of how much you can borrow in comparison to the second or third tier lenders. And then now in a market like this, like we had in the yesteryear markets, you've got the semi-private lenders coming in as well, where they're a whole lot more flexible, right? So they can help free up the equity a lot more easier. They have less rules to play with. So getting onto a broker that has the ability to tap into that market of lending is really important, and can make and break your portfolio, because right now, what's really stopping people from investing and from adding to the portfolio are three really simple things. First is mindset. Right? So you've got to fix that. If you're listening to this podcast, of course, you're already fixing it. Right? I've got a green couch. You can come and lie on it and I'll talk to you.
Has he got a green couch?
Oh my God.
No, I don't.
That's where he sleeps.
When I'm in trouble.
When he's in trouble.
We used to have that futon
Yes,
sofa.
we did. Oh my gosh.
In the very early days.
When he
where it
made
was
bad buying decisions.
Yeah,
You're out there.
That's it. Yeah. So, you've got the mindset thing.
When we had lots of properties but no cash flow.
Yeah.
So, which is my next point, which is the cash flow side of things.
Yeah.
And then obviously the ability to get the deposits.
Yeah.
So if we look at all of those things, can't go wrong. Can't go wrong.
Yeah. And again, they're called fundamentals because they're just the basics, right? And nothing's really changed.
Nothing's changed.
There is a play now towards yield. How much of that should be influencing your buying decisions, do you think, Reshmi? Does it, is it still about capital growth and the yield is a secondary consideration?
I think you have to approach the yield in such a way, what we were discussing in the car, that the yield has to be really, really good, because right now there's the chance of it dropping, right? So yes, your capital growth is important, but we know that there's a movement happening. So you have to be really focused on the yields. Like you have to get that. What did we say? We're not going to use the jargons, and I'm just tempted to use the jargon here. Go on. You clarify for me, because
it's not giggle money.
No, it's not giggle money.
Not.
No. Yeah, so there was a coin, the term that we coined in the car. Now it's totally slipped my mind. But where we're going with this was that there's two facets to investing. One is the growth, the other is the yield play. And so yield actually determines how much negative cash flow you're going to carry with that one property. And then also in your portfolio. So for some, it would naturally mean you're going towards, say, perhaps well-located units and villas, right? I'm not talking your high-rises. I'm talking your owner-occupier quality units. So we need to now vary our term of 60% owner-occupier, because now we can, if we're going units and all, we want to be closer to the city, right? When I say city, I'm talking your main drags. So the owner-occupier could then be not necessarily the suburb, it could be the block, has got more than 60% owner-occupiers. It could be the street, right? So you'd have full of renters, but that particular street has got more owner-occupiers, right? So you need to now start looking at it granular. And, most of the time you'll get, your 5%, 6%, 7% yields in these properties. In fact, we helped our clients buy in the inner ring of Melbourne. We had a block of units where we had 15 units in there, individually titled, and it just went unconditional yesterday. And there was another buyer, even though we were under contract, where he was coming in with a 200K higher purchase price, unconditional. So we had to scramble to get everyone,
for the whole 15.
Yeah, for the whole 15. So
what was the sort of total price point for the?
So average pricing there was about 350, 380. The yield position was 7.2 was the lowest yield right? So, if you're borrowing your money at 6%, your yield position is 7.2, we control the cost of the strata because we own the whole block.
Yeah.
Makes sense.
Yeah.
So, that block now is 100% investor driven, right? However, that street in that suburb, which is a few back streets away from the water, is largely owner occupied. So that's where the transient migrant people come in. They have their first home, first ownership, then they transition out of there. And so when you look at this suburb demographic over there, it is tilted probably 70% to renters and 30% owner occupiers. But we are that close to the lifestyle, we're that close to the city, and that particular street has got more of an owner occupier bill. That's okay. So that's where the yield compression would the yield play would come in. So we still want the growth, and we acknowledge that the growth may not happen in the next 12, maybe even 18 months. So it's really important to have a higher yield. Now, that does not mean that it's got to be 10% you're buying whoop whoop. It's a higher yield in the sense that we want to be within our tolerable negative cash flow position for that property, buffering in perhaps another 1% interest rate rise.
Which, on all accounts, there's a rate decision in a couple of weeks' time, I think.
7th of August.
In the 7th of August, less than in a couple of weeks. And the indications would be a rate rise as it sits right now.
The talk's different with the banks, right? So one bank saying it'll be same, another is saying that there will be a rise. And I don't think anyone's actually talking about a cut.
So there's a lot of that. So we're spoken about manufacturing equity. We've spoken about the basic fundamentals of stuff, but how to handle a slowing market. A big aspect of this is sort of this strategic pivot to maybe the type of assets you're buying, where you can add a second dwelling to it, whether that's a subdivision or otherwise, or a granny flat. Let's talk about that for a moment.
Sure.
Do those type of assets become a premium in this market because everyone's out there looking for them?
Yes and no. Yes, because they're chasing the yield. So a house where the granny flat's already built, or a duplex, both sides, perhaps will come into its own element as a premium because everyone's chasing yield. If you look at it from the two aspects, the investors that are just starting out and the investors that already have got a portfolio developing, the approach is a little bit different. So for an investor that's just starting out, let's say we bought a house where it is potential to add a granny flat or potential to add another dwelling, we may want to do that sooner rather than later. So I'll give you an example, right? So over the weekend, I went to an auction. I jumped back on the tools.
Did you enjoy it?
Yeah, absolutely I did. Absolutely I did. And big shout out to you, Gordon. So we went to auction in the southwest of Sydney. We picked up a 3-bedroom house on a 530 square meter block at the price we were paying 4 years ago.
Okay.
Right. So we picked it up for $770,000. Context: February this year, same footprint, same land size, same suburb, sold for $850. Right. So there's a discount there. Yeah. Now, when you look at those figures, this house is going to cost this client $30,000 a year to hold.
Yeah.
Right. The rent possible and the outgoings, mortgage and so forth. So could we buffer that down? Yes, we can. Being a first-time investor, we will introduce the granny flat sooner rather than later. So the plan is that we get the front house tenanted with a condition in the lease that we'll build a granny flat. We already pulled the trigger on getting the plans done.
Pre-sale or?
So we haven't settled yet.
Okay.
Yeah. So we've got 56-day settlement.
Yeah.
So I was
56 days.
Yeah. So
okay.
terms.
Yeah.
Right. So I was strategic in going longer settlement, so I have enough time to plan the granny flats for him. And so the granny flat will cost us circa $250 to $260 on that. Yeah.
So the idea being is that you should have all approvals ready to
roll.
on
Ready
the day
to
of
roll. Yep.
settlement. You can start building the granny
Correct.
flat
While still renting out the front bit.
Yeah.
Yeah. So it'll cost us circa $250. The rent on it would be $550 per week. Yeah. So it's going to introduce about $8K of freed up cash flow, because we still got to pay for the loan on the granny flat.
Yeah.
Right. For something that was going to cost him $30K to hold per year, now all of a sudden we are very close to $20K a year, and reducing. Right. So what I've done is two things. I've reduced his negative cash flow. So it's actually slowed him down. He won't be able to acquire the next property
In about
in a year, 2 years' time, right? But his cash flow is there now, so he'd be able to, based on just the cash flow and deposits derived from elsewhere, he can go again on a smaller property, perhaps one of those St Kilda units.
Again, keeping in mind the pod that we talk about, the pod system. So the different types of properties bought in different sequences based on your own scenario and what the market is doing. And so as a combination, these are the 4 or 5 dials we have, and you just have to match up what works for somebody. And in this case,
you bring in the old X-ray things, right?
Yeah, all the dials. Yeah, because you have the client whose scenario is such and such and is a first-time investor or beginner, and then when we are in such a market which things are not quite, it's a very good market for investors. Then we have finance, and he is limited with finance. So looking at all of that, you've got to just make sure. And then that's why the port system works really well, because you know that no matter what, if you did this port system, any investor, if they bought the properties that are described in the pod, they will have a very good portfolio and they will generate the income while they're young. To be deriving the income and living your life from that income. I mean, why are you investing? You're not going to be putting all your life into it. And then in the end, one day you say, yeah, I got this, but then you haven't got a life to live after that. So you want to have all this set up so that while you're still young, you can start generating income from it. And so that is what we're trying to reflect with in Gordon's case, is that based on what's going on right now, that is the approach for him to build this portfolio within this port scenario.
Yeah. And you should get the arbitrage on the capital uplift when values return, right? Yes. So you're buying at a discount. It's contingent. You can't realise that until the market returns. So this is on the assumption that the original place alone should at least revert back to its comparison from 3 or 4 months ago. But you've put another 250 K's worth of asset onto that, which should
bring you very close to the mill mark, right? Yeah. And to put colour to this. 4 months ago, a house plus granny flat in that suburb came in with a 1.2 price tag.
There you go.
Yeah.
Yeah.
So we are locking in a sure shot 200K uplift. We don't know whether it's going to happen in 12 months or 18 months.
Assuming the thesis that property will go back up in value.
Just remembering I've been around the sun a few times. So
Yeah, and so, but you got to be absolutely committed to that thesis, that
and
property,
hold your nerve,
and hold your nerve. And the government's been very clear. They've said we want prices to grow slower than what they have done. So you're buying the optionality of upside in the future. How important is sort of restructuring all your loans through this sort of period of a slower market? It's this is when again the stuff which you might have overlooked or didn't pay too much attention to because you're worried about capital growth, it starts becoming a lot clearer what you need to be doing.
Very much so. So
freeing up cash is very important right now.
And also, so reason for freeing up cash right now is we are going to go reduction in value across the portfolio for the interim. So you want to have that money freed up even if you don't need it. Right? So go back to the bank while you still qualify and while the banks are still semi-optimistic in terms of the valuation, and extract as much money back out, provided you don't go beyond 80% loan to value ratio, right? That, and I'll come back to that in a second. And then you're also really looking at it from a lending point of view. It's changing. You perhaps need to go to a different lender, which you may not have heard of before. The color of the money is still the same. And understanding that the whole thing is about resetting the cash flow and bringing back in liquidity. So if you've extracted as much of the equity out and put it in cash, so whether it's in an offset account, preferably offset, not redraw, now's the time not to cross-securitize your loans. So early on, we talked about it's okay to cross-securitize, right?
Yeah.
Different market where the market was barreling ahead. So even if you had to sell down one property or had to refinance one property, the bank wouldn't pull the trigger and value everything in the portfolio. At this point in time, if you cross-securitize, you try selling down one property because that might be the relief valve to get you a few more years of holding on. The bank might turn around and revalue the entire portfolio that's cross-securitized, and they will say, okay, the sales proceeds frees up 200. I will take 100 out of that 200. Kills your maths. Yeah. So we need to be very, very mindful that any properties you add, standalone loans until the market returns to normalcy. Then you can decide whether there's efficiency in cross-securitizing or not. Yeah. The 90% loans, where we had talked about, this is where it comes back to being able to maneuver. At 80%, you've got a greater flexibility because you're not also having to go through the tick boxes of the mortgage insurer to get your 90%. And let's agree that the market's going to come back 10%. Some places it already has.
Yeah.
But let's say it does come back 10% across the board. At 90% LVR, you've got no equity left, no maneuverability. Yep. So
that's a dangerous position to be in, and a comfortable position, vulnerable position to be in. That's the last place you want to be as a private investor. Is when you're vulnerable. Is when you start making.
Yeah, it's just your mindset, right? It just plays with your mind when you at zero equity position.
Yeah, it's not a nice place to be.
No.
So yet to. And probably outside the scope of this particular podcast, you want to actually get a sense of what my real views in this. You could probably go and listen to some of the other stuff that I do. I'm quite considered on this particular podcast. But
like
we
the
should
property buzz?
Yes. Yeah, you said it. If you really want to know what I think, which people really like for some reason, by the way, the gloves are off for that. But this is important. If you subscribe to this idea of property investment post-COVID and you were scrambling like many different people to accelerate your purchasing through setting up trusts and doing high loan to value mortgages in locations which were flooded with investors. I think of Townsville, for example. That's just an example. I'm not saying that exactly, but an example. How worried would you be? Like, because are you going to, you're just not going to be able to probably exploit this market as a property investor. That's the missed opportunity.
Correct.
So you could probably hold on the rental, but you've lost your negative gearing. Trust-based lending's gone. The private banks still like to do it, by the way.
Yep.
They're okay. They just like to do it direct, not through a broker. But you're probably just going to, because of that short-term sugar hits that you were looking for in these areas, which maybe less so fundamental orientated, you're going to maybe miss out.
True. And this is where it highlights that you should not be jumping onto fads, right? If it's too good to be true, it is, right? And then you also, like we said before, you need to look at it from a household budget rather than, okay, I'm going to get continuous lending.
We also talked about, the headlines, the decisions you make for the first, like with 12, it's for that 12 months or for the full 10 year. So this,
it's about designing your decade.
So
absolutely.
You're looking at a trajectory of 120 months for potentially 6 months worth of negative headlines. So you just need to look at the bigger picture.
Bigger picture is good. So I hear where a lot of people are retreating and getting smaller in this property investment advice game. You're actually growing.
We're growing. Yep.
Why are you growing and other people are doing negative growth?
Because negative gearing is out of the window.
Which you've never really used.
Never used. So this is more to support our existing clients and then also be able to handhold the new investors through this market and keep up our value proposition of our service.
Yeah, okay. Good. So you're still recruiting. So if
Still
anyone,
recruiting.
so this could be a recruitment video as well if anyone
This
wants
could
to
be,
come and
yeah,
have a chat.
yeah.
What do you look for in a team member? What's like what matters, Reshmi, for
Oh, wow.
to join the
We
the
have
RPG
certain
team?
values, and after those values, their attitude, and after that, everything we can teach. They must understand investing, though.
Yeah. So you like people who have a bent towards investing,
Correct.
who are probably investors,
Mm-hmm.
which is a natural
It
sort of,
is, yeah.
origin for people that work in this space.
Yeah.
But a lot of it you can teach a lot of it.
You can. However, we do have a thing in the with our team that everyone, when they're working here with us, it's we are all a family, and we all have to go on that investing journey. So we work with our team as well to build their portfolios.
Yeah, it's good, isn't
So yeah,
What a great upside! Like we have it
Yeah.
in the Momentum Media business. So many property investors.
Yeah.
You
Yeah.
sit there and just go like, what better place to actually
Yeah.
outside of maybe working directly with a buyer's agent to learn
yeah.
about this,
Absolutely.
and you see how they start building portfolios.
Yeah.
Yeah.
And
Sit
if
there
people
and
are committed, want to do that, then that's like, okay,
Yeah.
we'll look at that. But
Yeah, that's
people
cool.
say, oh, I just want to work or whatever. Like, no,
it's not right.
no.
So, sort of digress a bit, but people go, what people want today is purpose in their work, right? And most people's purposes, their organisations, all a bit sort of fairy, right? Like, we're trying to solve world hunger or whatever. Like people want these really emotive purposes, right? Like if your purpose is that you make people create better circumstances through property investment, it's not a bad purpose.
That's not a bad
My
purpose.
sort of
purpose at all.
purpose there was that we create enough. When we first started investing, I thought there's a lot of homelessness out there. Lots of really bad situations people are in, and the idea was let's make enough money that we can help everyone. That was like a 20-year-old thinking, right? So that goes out the window when you grow up and you mature. And then I thought, you know what, we can create a lot of people's wealth, and together we can make an impact. So
It's a significant impact.
Yeah.
If you change people's financial situation for the better,
Yeah.
families are happier, relationships are happier.
Yeah.
Everything is better when you are less vulnerable.
Yeah.
That's right.
And
if you look- sorry,
we are actually the other idea was like if there's a lot of if we create a lot of wealthy people, we all can join forces and help towards that. And now with the development we're doing with the Warby Street one,
It's creating,
it is creating like
it's
that.
creating
So-
supply. It's creating a roof over people's head, and
Is that the one that you did recently? That
this is a block of townhouses we've been strategically buying into until we control the whole block.
okay.
yeah.
And now we're in talks with council to put multi-story building there, and a big tilt of that will be towards affordable homes, so that we are actually putting supply where it really matters, where people that are not as fortunate will have an affordable roof over their head.
See?
It's a good thing to do. Good thing to do. Not all property investors are evil, Victor.
No,
Despite what
that's right. Yeah.
some cohorts would have you believe. It's good. All right. So there's people there can chat with you if you're concerned, just curious potentially of what all this slowing market means for your portfolio. No doubt get in touch. But if you want to be proactive, like me, we're going to have a chat as well. We've lost a bit of momentum
I know.
recently. Got to get it back. I'm good to go.
So he says.
So I'm good to go. We missed that on
We
one.
missed it. We did.
When was that? Late last year? No, early this. I can't remember what
No,
it is.
it was early this year.
Early this year.
Yeah.
Which we signed a contract and everything,
Yep.
but some sort of
Naughty solicitor came
naughty solicitors in the grey doing things which probably weren't appropriate. But I reckon we probably dodged a bullet anyway. That's how I'm framing it. But
in.
I don't
Of
know.
course. Yeah, we can sugarcoat anything these days.
It's a great thing that's happened. But so what do people have to do? How do people track you guys down?
We've got a checklist happening in terms
Yeah.
of
This-
how to cope with a slowing market.
Okay.
So if you wanted the checklist, send us an email, questions@rightpropertygroup.com.au.
Yep.
We'll put it on the website at some point in time as well. But if you wanted an early release of it, questions
Yep.
at rightpropertygroup.com.au.
RIGHT. Yeah.
And if you wanted to have a chat with us, certainly just jump on our website, fill in the contact me form, And there's a bit of a process of information gathering so that when you do chat with us, we are actually talking about strategy and talking about your direct case rather than still information gathering.
Okay, good. I encourage everyone to do that.
Yeah.
Nice one. Well,
Awesome.
good to see you.
Thank
nice
you.
one, Reshmi. Victor, great to see you. And this is part of our Design Your Decade series, the special series inside of it, which is how to handle a slowing market. And the key thing is that be comfortable with a slowing market. There's certainly opportunities in there, but it's how you orientate and configure yourself around it will determine how well you can navigate it, exploit it potentially, and use it as a moment in time. No doubt in 3 or 4 years' time, I'm going to be sitting here with Victor going, why didn't I do more during that period of time? So I don't want that to happen this time. So I'm working on it. So
Watch this space.
Watch this space. So thanks for tuning in, everyone. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature, does not take into consideration your financial situation or individual needs, and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you.